Friday. It's October 7th, and that rotten Janet Yellen keeping interest rates down to help crooked Hillary. I know that's what's going on. It's what everybody knows. I'm working on shorter neckties. I had him take some of the orange out. Do you think it's too matchy-matchy? I'm very smart. I know a lot about hair. And I know that's what's going on at the Fed. Everybody knows that. Actually, that's not what's going on at the Fed. As the copy nearby tries to describe, there are two basic approaches to what's going on in the economy and what should go on with interest rates. But none of them has anything to do with anybody at the Fed trying to dress markets for the election. We don't do that. The Fed did that once, 1972, and it's still embarrassed about it. And Arthur Burns, wherever he is today, is probably still embarrassed about it, but that's not what the Fed does. The argument today, and interest rates are up a little bit, mortgage rates are up a little bit, is the traditionalists who are always worried about inflation. They can find inflation when there isn't any inflation, but that's what they're worried about. They think the Fed funds rate at roughly 0.4% is way too low, and what they ought to do is to come up some to make it easier for them to go up farther when inflation finally is a problem, if it's not a problem now. Now, as you can suspect, I think about as much of that wing of the Fed as I do about some of the candidates in this year's election. There's another group, which is the dominant one, certainly the one that Yellen is in, which is more worried about the world and sees the world as a more integrated place than it's ever been, and sees the United States as subject to more global pressure than it ever has. And this week, the International Monetary Fund downshifted its forecast for global growth again to 1.6%. That's in a range so weak that almost any economic shock outside could tip the whole shebang over. One of the shocks that might do that would be a prematurely tightening Fed, or too aggressive. There's some Fed politics in play. There are 12 regional Federal Reserve banks, which are appointed, and their presidents are appointed by local boards, most of whom are made up of local business people who have no business anywhere near a central bank. Sometimes they're good people there, and sometimes they're not, and this is one of the phases in which they're not. The Fed itself, the Fed governors and chairmen, are nominated by the president and confirmed by the Senate. That group is unanimous in the global view that the risks are very much on the side of don't do anything too fast because you may regret it and you may have a really hard time fixing it. It is the regional presidents who are the ones that are on the airwaves. As this week concludes with rates up a hair, I mean, we're barely out of the range of 3.5 that we've been in for the last 4 months. I wouldn't worry about it. The odds are against any sharp rise in rates. The Fed might do something really strange and increase its interest rate just before the election, but it makes no sense for them to do that for all sorts of reasons, some of them political. The Fed meets again in December. The Fed is likely to add a 1/4 point to its rate at that meeting and then see what happens afterwards. But nothing really to worry about, not in the housing market, not for mortgage rates. Thank you very much.